Something significant is unfolding inside Iraq's monetary system, and serious investors are paying attention. The Central Bank of Iraq is sending signals that go beyond routine statements, and those signals are rooted in numbers, reserves, liquidity management, and exchange rate discipline. Iraq's foreign currency reserves have been reported at over $100 billion, a level that places the country among the stronger reserve holders in the region. That figure alone carries weight. Reserves of that size provide coverage for imports, support the banking sector, and strengthen confidence in the Iraqi dinar's managed exchange rate environment. The dinar has remained anchored near 1,300 Iraqi dinars per US dollar, reflecting deliberate policy control rather than uncontrolled market drift. Stability at that level requires consistent intervention capacity, especially in an economy that imports a substantial percentage of its consumer goods and industrial inputs. When demand for dollars increases, the central bank must supply liquidity to prevent price shocks and currency panic. With reserves exceeding $100 billion, Iraq maintains the ability to absorb external pressures, whether they stem from oil price fluctuations, global inflation, or regional disruptions. Oil revenues continue to generate the majority of Iraq's foreign exchange inflows, and oil production levels have supported steady dollar accumulation. In recent years, oil revenues have accounted for roughly 85% to 90% of government revenue, making energy exports the backbone of reserve growth. These inflows strengthen the central bank's position and reinforce exchange rate stability. Investors should understand that currency stability backed by reserves is fundamentally different from artificial support without liquidity. Iraq's signal is clear. The dinar is operating within a controlled monetary framework supported by measurable financial resources. While reserves alone do not dictate appreciation, they dramatically reduce the risk of disorderly depreciation. In global currency markets, risk reduction is often more important than speculation. The central bank's reserve strength sends a message that policy flexibility remains intact and that liquidity constraints are not driving decisions. For investors monitoring currency developments worldwide, the key takeaway is that Iraq's monetary authority retains operational capacity and defensive strength. Beyond reserves, the Central Bank of Iraq has focused heavily on tightening oversight of dollar flows and improving compliance standards within the banking sector. These actions reflect structural adjustments rather than short-term reactions. When a central bank strengthens oversight mechanisms, it often aims to reduce illicit dollar demand, narrow gaps between official and parallel exchange markets, and improve transparency in cross-border transactions. Iraq's managed rate near 1,300 IQD per USD operates within a framework that requires disciplined liquidity control. Even small imbalances in dollar supply can widen spreads in informal markets. By reinforcing regulatory oversight, the central bank reduces speculative distortions and stabilizes expectations. In emerging markets, currency crises frequently begin when market participants lose confidence in institutional discipline. Iraq's current policy signals emphasize discipline rather than abrupt currency change. Inflation control is also a key factor. Imported goods represent a large share of consumer consumption, and currency weakness can quickly translate into rising domestic prices. Maintaining exchange rate stability helps moderate inflationary pressure. Global inflation in recent years has exceeded 5 to 8% in many economies, and energy price volatility has added additional stress. Iraq's ability to maintain currency stability during periods of global inflation reflects the importance of reserve-backed intervention and monetary control. Investors often look for dramatic rate shifts, but institutional strengthening is frequently the more meaningful development. Currency modernization typically occurs after compliance systems, reporting standards, and banking transparency are reinforced. Iraq's reforms align with international financial frameworks and aim to reduce systemic risk. The signal being sent is not about immediate revaluation, but about long-term stability. When a central bank emphasizes regulatory tightening, reserve adequacy, and controlled liquidity, it communicates that policy is being structured around sustainability. For long-term investors, sustainability often carries more weight than short-term volatility. Iraq's central bank appears focused on reducing structural vulnerabilities rather than triggering rapid market moves. For Iraqi dinar investors across the United States, Europe, Asia, and the Middle East, the broader implication of these signals lies in risk management and monetary sequencing. Strong reserves above $100 billion, combined with steady oil revenue inflows and exchange rate discipline near 1,300 IQD per dollar, form a framework built around stability rather than speculation. In global currency markets, countries with weak reserves often face forced devaluations exceeding 10 to 30% during periods of stress. Iraq's reserve buffer significantly lowers the probability of such disorderly adjustments. Instead, Policy flexibility allows for measured responses. Any future adjustments to the exchange rate structure would likely be deliberate and coordinated rather than reactive. Investors should also monitor reserve trends relative to import coverage ratios. A healthy reserve position often covers multiple months of imports, providing insulation against short-term trade shocks. Iraq's oil export model continues to replenish foreign currency holdings, reinforcing liquidity strength. While no monetary system is immune to external risks, reserve adequacy dramatically improves resilience. Central banks that operate with strong buffers can implement reforms gradually, manage expectations effectively, and maintain credibility with global financial partners. The message being transmitted by the Central Bank of Iraq is one of capacity, control, and continuity. Stability does not generate headlines as quickly as dramatic rate changes, but it is the foundation upon which sustainable monetary evolution is built. For serious investors, numbers matter. Reserves above $100 billion, oil revenue dominance near 90% of fiscal inflows, inflation pressures contained relative to global spikes, and exchange rate anchoring around 1,300 IQD per USD. These data points form the real signal. Markets reward resilience over time. Iraq's current monetary posture suggests a preference for controlled progression rather than sudden currency disruption. For long-term dinar observers, that signal may prove more significant than any short-term speculation.